So the first thing that we need to do is obviously define what a control account is. So you've put a nice heading there, Chapter 13, control accounts. When you're controlling an account, you're obviously looking at the balances. Okay, so what accounts do you think we need to control?
Bank.
Well, bank would be part of the bank reconciliation.
Yeah, okay.
A control account would be mainly for who? Yes, debtors and creditors, 100%. Okay, so you can put a note there. Control accounts exist for trade receivables and trade payables. Right, if you look at the textbook in the paragraph at the beginning, they say that control accounts are used to check the accuracy of the sales ledger and the purchase ledger, which is looking at the receivables and payables. But in your textbook, they talk about receivables and payables, so we can use that to describe the debtors and creditors. Okay, which one is the debtors?
Debtors is
Receivables. What type of element is it? It's an asset. Good. So what balance would you expect it to have? Good. Okay, so let's summarize that as well. Right, so on the next line you can say trade receivables equals debtors equals asset equals debit. Okay, so we're just revising the basics. But it's important to know what something is because then we can actually record it appropriately. Okay, so trade receivables equals asset equals debit, yes. Okay, and that's obviously the debtors. Right, then the textbook goes on and they talk about sales ledger. So a sales ledger would be for who? The debtors or the creditors?
Yes.
Yes, okay, so underneath that you can just put brackets, sales ledger. Okay, what is the difference between a journal and a ledger? We've covered them before. You've looked at a general journal and you've looked at different, well, actually lots of different journals besides the general journal, but you've also looked at the general ledger. So how are those two things different? What is the general ledger and what is the general journal?
General journal records each transaction.
Good. Okay, so here we've got the general, well, not general ledger, we've got the sales ledger.
Yeah.
So what exactly is a sales ledger?
It records all the sales.
No, records
All
all
the debtors.
the debtors, exactly. Okay, so that's important. So under sales ledger, you can just say a record of all the individual debtors. Right, so everybody will have their own separate account. You'll have an account for A, B, C, D. It doesn't matter how many debtors you have, everybody will have their own accounts. And why do we need that? It's to control that account. Right, because what are you going to do with your customers? You're going to follow up, right?
Yeah.
Okay, so if you have a customer who's a debtor, did you sell or did you buy from them? Did you sell to them or did you buy from them?
No,
A debtor. You sold to them. Okay, so if you've sold something to your debtor, they're a customer that's owing you something. Do you agree? So now if I'm going to follow up and control, inverted commas, the debtor, I need to make sure that I know what they owe us because we're going to phone person A, B, C, D and we're going to say, please can you settle your account? Or please remember that this is outstanding or whatever the case might be. And that's what you're going to do. So that's the purpose of the control accounts.
Yeah.
Right, so the reason why we have a sales ledger is to monitor and manage individual debtors. And that's what you've got there. Okay, let's just see if there's anything else here about the sales ledger that you can make a note. We can about the journals here. That's important. Okay, so they've given you a nice diagram here. If you want, you can maybe say the big diagram is on page 97. You can just put a textbook reference. Page 97, large diagram. We'll summarize it in terms of the different journals. Okay. Page 97. Alright, the summary is what we're going to do in a T account. Okay, so remember we're doing a sales ledger. A sales ledger is a T account that's going to record all the movements that are possible for that specific category. Okay, so in this case, trade receivables. Right, so let's draw a T account. You're probably going to need about 7 lines to write down a few contra accounts, okay, transactions.
How many lines?
Let's leave 10 just to make sure we've got enough space because I want to put everything possible. In the examples, they're a bit limited because they don't cover all of it, but we'll discuss all of it when we actually record it.
So this is the sales ledger.
Yes, so the heading for this, according to the textbook, they don't talk about trade receivables, but you can. They say sales ledger control account. That's what they use to label this T account. Okay, but what is this T account basically describing? It's describing everything that relates to the trade receivables. But they just call it a sales ledger control account.
Okay.
Right, so just remember that this is the same as a T account for debtors or a T account for trade receivables. Right, so what would you expect to see in that account?
All the debtors.
Opening balance, right?
Yeah.
Okay, where would that go?
On the debit side.
Yeah, on the debit side. Okay, so on the debit side, opening balance, so it'll be 1st of, you can just say 1st of January. The month is not that important, but it must be the 1st of the month. And then you're going to write balance, brought down. And then you can just put a balance, let's say 100, just to keep the number simple. Okay, we'll balance it at the end. Right, what else would you expect to see in that account?
Sales.
Very good. Where would the sales be?
Also debit.
Also debit. Perfect. Okay, so on the debit side, that'll be for the end of the month, so 31st of Jan. You would expect to see sales.
Would that be like the total because it's at the end?
Correct. Okay, and which journal would that have come from?
DJ.
The DJ or the SJ, the sales journal. Right, what do they use here? Okay, they refer to it as the SJ. Okay, SJ, DJ, either or would have been fine. Okay, SJ. And the amount, let's say 500. Right, and remember the sale is representing everything that the customer has bought on credit. Okay, because that's the purpose of this. It's maintaining a record of all the trade receivables.
Okay.
Right, what else can you see in that account?
Maybe when I return sales.
Very good. Where would that go?
Credit side.
Exactly, great.
Also on the credit.
Yes, okay, because your journal, your sales returns journal will record all the individual returns, and then you'll obviously summarize that as a total, and you'll post one amount through. Okay, SRJ is the folio, and then let's just keep it simple. Let's make it 150. Sales returns journal. Okay, so the sales journal is like the debtors journal, and the sales returns journal is like the debtors allowances. Okay, I'm just using the vocabulary that's here, but again, it depends on the question. I'm going to stick to what's in the textbook, so we answer questions in terms of what they have here. What else do you have? That's it, eh? Oh, the amount. You can just put 150, just to keep it simple. Okay. Right, what else can you see in a sales ledger?
Discounts.
Okay, when do discounts arise?
Discounts allowed.
Okay, good. So you allow discounts to your customers when they do what? There we go. There's the answer. Okay, when they pay. Right, so if they pay, would you debit or credit the T account?
If they pay, you can debit it.
No.
If it's a discount,
If they, why would you debit the account? If you debit the account, you increase it.
Correct.
Yes, okay, so if the customer pays the business, do you agree that your debtors will go down, and that's why you're going to credit the debtors? Okay, so on the credit side, you're obviously going to write down cash or bank. You can actually write down cash/bank. In the examples here in the textbook, they use the word cash. Okay, but remember, people can pay using an EFT. They don't have to pay with physical cash.
So if they say cash discount?
Well, you've got to use two separate lines.
Okay.
The first line is looking at the receipt of cash. Okay, money coming into the bank or money coming in form of cash. Okay, so cash/bank, depending on how they describe it. Which journal?
What's the COG?
Very good. Yes. Okay, cash receipts, good. Okay, the reason why is because bank would have gone up and you would have received a payment from your...
COJ was sales return journal.
No, SRJ, sales returns journal. CRJ is cash payments journal. Okay, I think what they talk about is CBR, cash book receipts. That's what they use, but it's the exact same thing. Okay, let's just put an amount. Let's say they pay us 120. Okay, then you spoke about a discount. You're right, discount allowed would apply to a debtor. Where would that go, debit or credit?
Credit.
Yes, okay, discount to reduce the amount that they owe us. Okay, good. Right, so 31st Jan, same date, different description. The description here would be discount allowed. Okay, the discount that you've allowed. And that would have also been part of the cash receipts journal. It would have been a separate column. Okay, amount, let's just keep it simple. Let's use 20, so the numbers are different as well. Okay, perfect. Let's see, we've covered the returns, we've covered the discount, we've covered the cash, we've covered the sales. Okay, so we've covered everything that's in the textbook in terms of examples. There are other things that can arise there. What are those other things? Okay, so these are additional that we can include that could come up. What else could relate to a debtor? Yes, very good. Okay, that's really good. You remember a lot. So a dishonored check is when what happens?
It's when they give you the check but they don't have the funds in the account.
100%. Okay, the check that they've given you bounces. So in other words, that bank that you thought you received didn't materialize. Okay, so on the debit side you would have check RD. Well, we can put that in brackets, but you'd have bank on the debit side. Yeah, so debit side 31st Jan. The description would be bank, and then in brackets you would write down check RD. That would be for a dishonored check. Okay, and that would have come from the dishonored checks go to which journal?
General journal.
General journal, no. Think about it. You initially received money, but now that receipt didn't go through, so you need to reverse it out. Cash payments. CPJ. Okay, let's make that 70. Okay, what else? There's one more. Actually, two more. Do the debtors always pay? There we go. Okay, credit losses or bad debts. What would that do to the account?
Would you write it off?
So debit or credit?
Credit.
Yes, okay, so on the credit side, you can put 31st Jan. You can write down credit losses / bad debt. Either or should be acceptable. I don't see it here, so I don't know if they're using credit losses or if they're using bad debts. Oh no, not with bad debts written off, just write down bad debts. Okay, I know we covered bad debts previously, so it must be somewhere in the textbook. It's not here currently, so it'll be later on. Okay, but bad debts would definitely be a consideration.
Bad debts?
Or credit losses, either or. Both are acceptable in terms of vocabulary. They both refer to the same thing. Customers that don't pay. Okay, which journal?
CPJ.
Yes, bad debts. No, bad debts would be general journal, yeah. Because bad debts would have been what? Debit the bad debts, credit the debtors, exactly. Okay.
The whole amount.
Well, we need to make an amount. We don't have things, we're just putting in amount so we can do the balancing. Okay, let's say the bad debt written off is 50. Okay, so 50 Rand worth of bad debt was written off. Okay, what's the last one? If people don't pay, what are we going to do? No, or bad debts recovered would be something completely separate that would be recorded in the cash receipts journal. Okay, so those are people that we didn't get paid from, and then later on in good faith, they say, okay, we owed you, we didn't pay you, now we can pay you, here you go. Okay, but that's separate. That's not part of the T account for debtors. Okay, what do you do to the people that owe you? How are you going to get them to pay you? Yes, that's the incentive. So you can incentivize your debtors to pay you by giving them a discount, or you can penalize them for not paying you. There's the answer. Okay, what is interest going to do to your debtors? Good. Okay, so 31st Jan, interest income. Which journal?
Maybe the journal.
Definitely. Okay, because it's unique, it's separate. You would have debited debtors, you would have credited interest. Okay, let's just put in 10. We've charged in 10. Right, and that's everything. Right, so now what do you do at the end of every T account? Balance it off. Okay, so skip a line, put totals, and then balance. So I'm going to leave you to do that, and let's see if you do it correctly. Did you bring a calculator? Okay. Yeah, the numbers are small, so it's not too hectic. It should be okay to add up. Right, so we need to first establish which side is bigger. Do you agree?
Yeah.
Okay, that's the first thing. Right, so 100, 570, and that's 580. It's not 680, sorry, my maths. 5, 1, yeah, that's 6, and then 7, 1, 8. Yeah, perfect.
Is that 680?
Yeah, how much do we have on the right? 270, 290, 340, yes, okay, agreed. Okay, so 680 was bigger. No, you don't write 340.
Oh, sorry.
Which one do you write?
680.
Yeah, you write the bigger amount because you want the same amount on both sides. Okay, so 680 is the total that is going to be recorded on both sides. Right, then you just need to do the balancing. Okay, yeah, so the credit side is missing, balance carried down, the difference, so 340 minus 680, it's half, so it'll be 340 actually. Yeah, 340 plus 340 is 680. Okay, that's quite coincidence that the numbers came out so nice. Okay, yeah, first off, fifth, balance brought down 340. Right, so now this control account represents what? The balance for everybody. Do you agree? Okay, at the bottom underneath this T account, just asterisk and just say every individual debtor can have their own separate account, which makes up the control account. Right, so we've only looked at the summary. We've looked at everybody's account as a summary, as a whole. Okay, you can look at individual debtors separately. Okay, so you could have debtor A having, so that balance that we had at the beginning, 100. Okay, that could have been maybe A's account that had 40 and B's account that had 60, and then 40 and 60 makes up 100. Does it make sense? Okay, so you could have had lots of debtors, but separate debtors that make up this one total. Okay, the reason why this chapter is called a control account is because you're looking at totals.
Yeah.
Okay, we're not looking at the individual debtors, we're looking at everybody's account as one, like that big T account. Okay, that's what they've shown you here. Okay, that's that bit.
So every individual debtor has...
Oh yeah, you didn't finish that, it's fine. Every individual debtor has its own T account. That makes up the control account. Okay, so the control account is basically the summary, because that's what we're looking at. We're looking at controlling and managing our debtors. Right, so the only way we can do that is by checking that our balances are in line with all the individual debtors. Does that make sense?
Yeah.
Okay, perfect. All right, so now we've summarized all the debtors. Okay, we've started with, we spoke about both at the beginning, but now we need to describe the payables. Okay, so the next part in the textbook, you see here, they say purchases ledger. Okay, so now we're changing focus. Who purchases? We do. So if we're buying, what happens? We have a liability.
Yeah.
Does that make sense? Okay, so that's the next part. Right, so you can maybe start on a new page and put a big heading. This is for the trade payables. Right, what are trade payables? Let's do the same thing. Yes, okay, so same as what you did previously. You can put like trade payables equals liability equals credits. Okay, if I have a trade payable control account, we would expect it to have a credit balance. Does that make sense?
Yeah.
Okay, what else did we put there? We also said, the ledger bit. So at the bottom of trade payables, open a bracket and you'll write purchases ledger. Okay.
Okay.
Alright, so we've got that. Then you can put an arrow and you can write down record of all individual creditors. Okay. Right, so we've got that. Now we need to look at the summary. So here you can say page 90. We don't have to say page 90 because that was the diagram for both. Right, so we're not looking at both, we're just looking at the one. Okay, so yeah, T account. The description for this heading is purchases ledger control account. That's what they use to describe the account for the creditors.
So this is, what ledger is this? Sorry?
What ledger is this? It's a purchases ledger, yeah. So heading purchases ledger control accounts. Alright, perfect. So now if we're looking at a T account that's a liability, where would you expect to record the balance?
On the credit side.
Perfect. Okay, so balance brought down 1st of January. Let's make it 200. Right, what else would you expect to see in a T account for your creditors?
So, purchases?
Very good. Okay, purchases would go where?
On the first
on the credit side, because they would increase your liability. Nice. Right. Purchases or total purchases, either or, because all of it would go to that account. Okay, and then what folio?
Computer? No, it's SP.
S is sales, P is purchases. So PJ, purchases journal, or creditors journal, depending on what they use and what textbook you're using. Okay. Here they don't even put the folios here. They put balance brought down, but they ignore the other bits. Okay, which is fine. We're just being more comprehensive. Okay. All right. So you've got that. Purchase PJ. Let's say we've purchased 1,000. Okay, and just to try to keep the numbers a bit short.
Okay.
All right. What else can you have in a purchases ledger T account?
Purchase return.
Good. Okay, so we can buy and we can also return. If we return, it's going to reduce the liability, so debit side. 31st Jan, purchases returns. PRJ, because that's the purchases returns journal. Okay, amount, let's say 200. Right, what else? What do you do with your... Yes, but when? When do discounts that are received arise?
When we pay.
Exactly, when you make payments. Good. Okay, what would payments do to your ledger account?
Increase.
Yes. Okay, so 31st Jan, that would be bank or cash, so cash/bank. Depending on how you're paying, that'll come from the cash book receipts or the CRJ, either or, doesn't matter. And amount, let's say we pay 300.
Okay.
Right, what discount?
Discount
Received, good. So debit or credit?
No, debit.
Debit. Okay, why? Because the discount would reduce the liability. Okay, so any discount that is going to affect the business is going to be on the debit side. Okay, good. Right, so discount received, perfect. Cash book receipt, same thing, same journal. Let's make it 30. Right, what else? You won't have as many accounts in the purchases ledger as you would in the sales ledger.
Purchase returns.
Purchase returns? No, we've looked at that already.
No. Oh, yeah, that's. Also, no, on the check.
Yeah, you won't have dishonored checks for you. You won't have dishonored checks. You won't have bad debts. Can you have interest? Yeah. Can your suppliers charge you interest?
Yeah, extra. Yeah.
Yeah, they can. Okay. All right. So, where would you put the interest? Yes. Okay. Because interest will increase the amount that's owed. Okay. So 31st Jan, interest expense. Let's make it 100.
And that would be from general.
Definitely. Okay. Interest would have to go to the general journal because it's something separate, something different. Right. That's it. Now what do you do? Balance. Right. So do the balancing again. And then we can just write a few other notes of theory. I see they just discussed something else here which we need to make a note of. And then we're almost... here's bad debt. There's it. Page 105. Okay, it's coming up. Right, we'll chat about that just now. We'll make some more notes. What else do they have? Okay, a bit of theory. Okay, great. We're almost done with this chapter. Okay, so which side was bigger?
Oh, sorry. 1,200. So 1,200. So just outside.
Yeah, the other side's actually bigger. Yeah, so you need to add up both sides and then you need to check which side's bigger. Okay, so 1,300 would be the biggest side. So I would put that as a total. Okay, so if you've got 1,300, then subtract the 530. And let's see what we get. Carry down. You'd have to work that out quick. 1,3 minus 5,3, 730. 770, yeah, perfect. Okay. Alright, and that's the balance, brought down balance. Carry down. Yeah, 1st Feb, next month. Right, is that okay?
Yeah.
Perfect. Then there's a few other theory notes that we need to make a note of, in addition to what you've summarized here. Okay, so these are all just additional points to consider. Right, the first thing that the textbook also talks about is credit balances in the sales ledger. So is it possible? So we spoke about the sales ledger there. Okay, is it possible to have a credit balance for a debtor?
Credit balance for debtor.
Is it possible? When would that happen? When would that take place? How would a debtor have a credit balance?
When they overpay us.
Yes, there we go. Perfect. So maybe write that on that page because there is space at the bottom. Okay, at the bottom, just asterisks. This is something else. It's on page 100. You can just say credit balances for debtors are possible. Credit balances for debtors are possible. Underneath that, you can just put example, e.g., if debtors overpay, we owe them. And that's why you have a credit balance, because a credit balance represents a liability, do you agree? Okay, so if they overpay, then you actually owe them, which makes them a creditor. Okay, but you don't call them a creditor, you just call them a debtor with a credit balance, right? Because a debtor is still your debtor, right? Hopefully, they're a recurring customer, and in the future they buy from you again, right? Then their account will go into the debits. Okay, so the only thing that they've described here is just that consideration, right, which is different to last year. Last year, you never ever thought about a debtor that overpaid.
Yeah.
Okay, we just looked at debtors that had accounts that were paid up in full. Never ever did we see an example where we actually owed them something. All right, so that's the first bit. That's what they talk about there, and that's what they give you as an example. Right, is that okay?
Yeah.
Right, next bit. So you've covered that there. Let's cover this here. Right, so can you have a debit balance for a creditor?
Yeah.
Yes, you can. Okay, so let's put that in as well. Asterisks.
Debit. What did you say? Debit balance.
Maybe let's keep it consistent with that. At the bottom, you can say every individual creditor will have its own T account, which makes up the control account. You can say the same thing, except you're looking at creditors. Okay, because I'm focusing on purchases. Right, the purchases ledger will cover creditors. Okay, let's see here. Yeah, that was all they had there that we need to cover. More theory at the end of the chapter. Alright, so we've covered that, So we're just going to make a note about the debit balances. Okay, did you write that down? Yeah, that makes up the control accounts. Okay, the textbook's quite good because they even tell you scenarios where this balance would occur. Okay, so like paying, overpaying. So now we're overpaying our supplier.
So it would be a debit balance.
Yes, okay, so asterisk, debit balances can arise for creditors.
Debit balances for creditors
are possible. Yeah, you can even write the same thing. Are possible. E.g., okay, so what scenarios are possible? Well, if we overpay our creditor, so we overpay our creditor. Okay, I'm just going to read some of the other examples that you could have. Right, if you pay the amount outstanding, but they give you a discount. Okay, so you don't pay the discounted amount, you pay them the full amount, but then they give you a discount.
Yeah.
Okay. Alright, so those are some of the ones that were described here, so that covers all of that. Okay, the textbook on page 103 talks about contra entries in the control accounts. Okay, you should know what a contra account is. What is a contra account? It's just theory. It's the pair of accounts that go together. Do you agree? Okay, so do you write down purchases in purchases?
Yeah.
No.
Oh, sorry.
Okay, you write down the contra account. Okay, so no, if it's purchases, we're buying on credit. Okay, so in purchases we'll have creditors control. In creditors we'll have purchases. Does that make sense?
Yeah.
Okay. Alright, and that's what they're describing here. So just remember that if you have a control accounts, contra accounts are what we use to set off those accounts. So we can actually look at two accounts that we can set off. So the reason why they spoke about this here is because you have debtors and creditors that are the same person, if that makes sense. So we need to add this. This is separate, this is different. You can put a note, okay, this is a completely separate. Actually, I would say start a new page because all of these things are separate to what you've got there. Okay, so you've got a page for debtors, you've got a page for creditors. Let's start a new page. Okay, so on this page you can put a heading, other considerations. Let's label it, and then we can say number one. Number one is contra entries in the control account. That's the first one. Yeah, other considerations. Right, the first one that they describe in the textbook is a contra entry or contra entries. It's multiple. Okay. Yeah, so that's the heading. That's great. The first consideration, number one, contra entries in control accounts, which are the T accounts. Contra entries in control accounts. Right, so that's the heading. Okay, so looking at what's here in the textbook, here they've given you a scenario where you have two accounts for the same business. Okay, so we need to write down some theory. At the bottom, just underneath this, you can say a business can be our debtor and creditor. Right, so if you're buying from a business and you're also selling to them, do you agree that those guys that you're transacting with are going to have two separate accounts?
Yeah.
Okay, you're going to have one account which is your debtor, and you'll have another account which is your creditor. Do you agree? Okay, so that's what we need to write down. Okay, so a business can be a debtor and a creditor. Second bullet. This business will have two separate control accounts. Right, so you'll have a control account for the debtor and you'll have a control account for the creditor. It'll be exactly the same.
This will have two separate?
Two separate accounts. Brackets, debtors and creditors. Okay, so you've got two accounts. You've got one because they're a debtor, and you've got another because they're a creditor. Right, like you've got here, just have a look at that example. Okay, then they've got H. Okay, sales ledger, purchases ledger. Right, you've got a debit balance for the sales ledger because they're a debtor, and you've got a credit balance for the creditors because they are creditor. Does that make sense? Yeah. Okay, so what they're looking at here in the textbook is this whole concept of set off.
Yeah.
Okay, so if I've got a debtor and if I've got a business that's a debtor and a creditor, can I eliminate their balances? Yes, because they're both one and the same. We need to check which is bigger.
Yeah.
Okay, so are their debit balances bigger than their credit balances? Right, so if let me think about that. Okay, so if we sell more to our debtor and we buy less from them, are they a debtor or are they a creditor? If
we sell more,
yes,
then
we buy.
Then they're creditors.
If we sell more to them, they're our debtor.
Yeah.
Okay, and we don't buy as much from them, so we don't have a balance that is bigger for our creditor.
Yeah, so then they're a debtor to us.
Then they're a debtor to us, exactly. Okay, that's what you're looking at there. Okay, so just to summarize that, the next bullet you can say set off occurs where. Okay, set off you can maybe put in capital letters because it's important. Or it's fine like that. Okay, maybe just circle it then or highlight it here, just to draw your attention to it. Okay, you shouldn't really set off things, okay, because set off is basically a little bit misleading. Do you agree? Because now you're saying, well, I've got a debtor of, let's say, 500, but I've got a creditor of 200. But now I'm not showing them separate. I'm just eliminating the 200 with the 500. So I'm only showing 300 as a debtor. So that's misleading. Okay, so set off is not the best way to disclose information to your users. Right? If you do have a debtor, and they're the same business, show them separately. Okay, but they're just describing this. So they may or may not use set off in some of the examples. Okay, we'll have to see what's in the assignment before we can decide on how important this is. Right, but at least we've made a note for it. So set off is offsetting one balance with another. That's what you're doing. Okay. Right, so if our credit balance is smaller, we would offset the credit balance with the debit balance, if that makes sense. Right, and that's what you've covered, and that's what they've covered there. Okay, so we've covered that. They've showed you some examples there in terms of set-off, which is literally just a transfer. Okay, so let's show that actually. But draw small little accounts. Okay, so small little T accounts, you're going to need two. Okay, so but put them next to each other, so on the left and the right. Yeah, so one on the left, one on the right. Yeah, small, literally 2 lines. Okay, for both, or 3. Yeah, it's fine. Okay, label the one. We can give it a name. Let's call it business A. Business A. And then you need to write down business A. And then in brackets, write down creditor for the one, write down, no, it's A and A. Yeah, remember, it's both the same business. Alright, they're just a debtor and a creditor. Alright, so for the one you write down debtor, for the other you write down creditor. Okay, so what they're saying here in the textbook is, debtors will have balances on their accounts. Okay, so let's assume that the debtor has a balance, so you can write down balance on the debit side, BAL. Yeah, just keep it short. Balance, let's say 1,000. Okay, for your creditor, business A has a, let's say, a credit of 200. Right, so looking at that scenario, is business A more of a debtor or more of a creditor?
More of a debtor.
Exactly. So this concept of set-off means we can transfer what we owe them to what they owe us. Does that make sense? Okay, so how do you do that? Okay, this you need to put in a different color. Okay, so maybe use green because you've circled the set-off. Okay, so set-off is going, what are you going to set off? Are you going to set off the credit balance with the debit balance?
The credit
Yes,
balance, because it's less.
because it's less, exactly. So what are you going to do here? On the debit side of the creditor's account, you're going to write down what? The contra account. Okay, so what would the contra be? The debtors.
Okay.
Yeah, so you'd write down on that side, just write down the word debtors in brackets transfer. Debtors bracket transfer. Okay, and then you would write down 200 because that's what you're transferring.
Okay.
200 is the amount. Okay, so does that close off the creditor?
Yeah.
Yeah, so you put your 2 lines and show 200, 200 and it's closed off. Okay, we don't balance accounts that have no balances basically. Okay, 200, 200, that's the end. Right, so now where's the 200 going to go?
Yeah.
Which side?
Credit
side, good, because see, on that side, on there you've got the debits, so on there you need the credits. Does that make sense? Okay, so on that side, write down brackets, creditors transfer. Okay, just showing the transfer from one account to another. Creditors transfer, 200. Okay, can we balance that account?
Yeah.
Yes, this one will have a balance. Okay, so you might have to add an extra line, just so that you've got enough space. Okay, so let's balance that account. Which side's bigger? Obviously the debits. So you'd want to see 1,000 on both sides. And then balance brought down, carried down. And that's that concept complete. Okay. Alright, then the last bit that they talk about in the textbook is some theory. Yeah, you must, yeah. So do that as well. So carried down would be 800. Brought down will be 800. And that's it. Okay, so that's the concept of set off. Okay, we've got one business, but there are debtor and there are creditor. Right, so instead of having 2 separate accounts for the same person or business, let's offset the one account with the other. Okay. Alright, then the last bit, okay, that covers that. Okay, then we've got 105 and 106. And here they talked about, okay, limitation advantages. Okay. Alright, so you've covered that as number 1. Okay, consideration number 2, second thing. Right, so that's we've covered that bit. Now you can put a heading for number 2, bad debts and provision for doubtful debts. Okay, that's the second consideration. Number 2.
Bad debts?
Bad debts and provision for doubtful debts. Okay, they don't talk too much about it in this chapter because the textbook even says a debt cannot be paid should be written off. See chapter 18. Okay, so there's not a lot that we can write here. Okay, because there's a chapter later that covers it. Yeah, that covers it in detail. Alright, so what we can just say here is what these things are. So put a bullet. What is a bad debt?
Bad debt is debt.
Yeah, but what is the elements?
It's
Which one? You've got 6.
Yes.
Yes, okay, good. Okay, because an expense is a loss of benefit. Okay, I've lost something. I've lost a debtor. I thought I was going to get paid from the debtor, but no, they're not going to pay you because of bankruptcy or whatever the case might be. Alright, so heading or bullet, bad debts is an expense. Right, in this chapter, all they did here was show what bad debt will do to the account, which we've actually looked at already. Okay, let's just highlight it. So on this page, maybe use a highlighter just to highlight the word bad debt. And then where's your debtors? There's it, eh?
Yeah.
Just highlight the debits for bad debts. The debit for the bad debt. Where's the bad debts?
Oh, sorry.
Where's the bad debt? Oh, it's actually a credit. There's the bad debts. Yeah, that's the one we need to highlight. Just highlight that. Okay. Alright, so yeah, that's what they're referring to, and that's what they've shown here as a little example. Okay, so that's very short. You can just put another note, another bullet. The provision for doubtful debts is what? Do you remember? What type of account do you think it is?
It's an asset. No, liability.
No.
Assets.
Um,
An expense.
think about it. It's a provision for something that's going to happen. Okay, so let me ask you about this. Bad debt, you know, is an expense. Do you agree?
Yeah.
Okay, so why would you make a provision for the doubtful debts? Meaning, why would you provide for stuff that you think you're not going to get? To make the books more accurate.
Yeah.
Okay, because what do you see in your tier account for your debtors? The balance. Okay, so let's look at that example. Okay, how much do we have at the end of Feb? Well, end of January, beginning of Feb.
Beginning of February, 340.
340. Okay, so now, do we or are we going to get all of that in the next month? Probably not. Okay, there might be one debt that chooses to not pay us. Right, so do you agree that 340 isn't an accurate amount? No, because we're showing 340. We're saying, okay, people owe us 340. But next month, so in January we had some bad debts.
Yeah.
We had 50. Okay, so we can expect maybe one or two debtors to not pay us in February. That's what we would expect. And that's why we make a provision. Okay, so if we're providing for bad debt, it's a negative asset. Okay, that was that was the bit that we needed to remember. Okay, so second point, the provision for doubtful debts is a negative asset. Okay, and the reason why it's a negative asset, you can write down in brackets there, it reduces the assets balance. It reduces the balance on the asset, basically. Okay, the assets balance, or the balance on the assets. Okay, balance on the assets accounts. Okay, right, that's what we're looking at in terms of the provision. Right, so we create it because we believe that not all of our debtors are going to pay us, and because not all of our debtors pay us, we're going to show a smaller amount. Makes sense? Okay, perfect. Right, and then the last bit here is just some theory here: advantages and limitations, and reconciliations. Right, I see even with the recon they haven't given you much because they're looking at checking, and checking will probably come up later as well because that would be a reconciliation. Okay, but let's make a note. It's not, you don't have to, I don't know if you can squeeze it in there. It might be too little space, but then there's not that much else to write. So do you want to squeeze it in? Okay, try squeeze it in. Just make a note. Okay, this is actually number 3 though.
Oh.
Yeah, so just put a little 3 and then.
Yeah.
Okay, control accounts, or let's say reconciling control accounts, just to keep it shorter so you can fit it in. Reconciling control accounts. I'll try to keep it short so we can fit it in. Okay, okay, so let me ask you about the purpose of a control account. What is it? What is its purpose?
To record everything.
Perfect. It's to record everything, exactly what you said. Okay, so if I'm recording everything, am I going to have all my debtors and all my creditors?
Yeah.
Yes. Okay, reconciling the control account is you are going to have separate accounts for every debtor and every creditor. Do you agree?
Yeah.
And that's what we're looking at. Okay, so a reconciliation is going to be checking the separate accounts with the total account or the control account. That's what you're doing. Okay, so you can write that down. Okay. So reconciling control accounts, right, involves checking the separate accounts with the control accounts. Control being the total.
Involves checking
the separate accounts with the total accounts or with the control account. You can just use the word control. Okay, control
accounts.
Separate accounts with the control accounts. Right, so that's looking at everybody's account, looking at debtor A, looking at debtor B, looking at debtor C, looking at debtor D, and checking that A, B, C, and D add up to the control. Does it make sense? Okay, perfect. All right, and then the last bit is just theory. This I don't think they'll test because accounting theory generally isn't the focus. They might test it in the assignment.
Yeah.
That's possible. But from an exam point of view, unless we see theory questions specifically looking at advantages and disadvantages, I don't know how important this is. Okay, so maybe on that last line, maybe just use a black pen just to asterisk, just say Advantages and disadvantages, page 108. It's purely theory. Here they're looking at why should we use a control account and why shouldn't we. Okay, what are the benefits and what are the disadvantages? Okay, that covers that chapter.